11 days. That is how long the largest futures exchange on Earth has before it faces a question it was never designed to answer. On February 27th, the first notice day for the March 2026 COMEX silver contract arrives. On that date, anyone holding a futures position can demand one thing: deliver my metal. The problem is straightforward arithmetic. Open interest on the March contract represents roughly 500 million ounces of silver. The registered inventory sitting in COMEX-approved vaults right now, the metal actually available for delivery, just fell below 100 million ounces, 5 to 1. 500 million ounces of paper commitments backed by less than 100 million ounces of physical reality. Now, in a normal market, this ratio barely matters. Futures contracts are financial instruments. Most positions get rolled or closed before delivery ever enters the conversation. But 2026 is not a normal market. In January, 49.4 million ounces were physically delivered through COMEX, 7 times the volume of January 2024. In February, the delivery rate hit 98%. Not 98% of total open interest. 98% of contracts that reached delivery windows actually stood for physical metal. That is not hedging behavior. That is not speculation. That is a systematic extraction of real silver from a system that assumed nobody would ever ask for it all at once. Every single day, roughly 785,000 ounces are draining from these vaults. At that pace, by the time March first notice day arrives, registered inventory could sit closer to 85 million ounces. And here's the detail that transforms this from a market story into a structural crisis. The drainage is accelerating, not slowing. The January crash, with that historic 31% single-day plunge that wiped silver from $121 to $74, was supposed to be the reset. It was supposed to shake out the weak hands, flush the leverage, and restore order. It did flush the leverage. Billions in paper positions were liquidated, but the physical demand did not stop. It relocated. In the days following the crash, the iShares Silver Trust recorded over 1,000 tons of inflows in a single session, the third largest day in the fund's entire history. The speculative froth evaporated. The structural bid for real metal did not. This is the story of what happens when a system built on paper promises collides with physical scarcity, when the math stops working, when 500 million ounces of contractual obligations meet a vault that is emptying by the day. March 2026 is not a prediction. It is a deadline. And the clock is already running. To understand how the silver market arrived at this inflection point, we have to trace the architecture, the decades-long system that made this collision inevitable. For decades, the global silver price was not set by miners pulling metal from the ground or by manufacturers soldering circuit boards. It was set in 2 places, the New York COMEX and the London Bullion Market Association. These exchanges trade what the industry calls paper silver, futures contracts, options, forward agreements, financial claims on metal that may or may not physically exist in the quantity promised. At the peak of this system, the ratio of paper silver to deliverable physical silver reached as high as 356 to 1. For every single ounce sitting in a vault, 356 ounces were promised on paper. This architecture survived for one reason and one reason only. Almost nobody ever asked for delivery. The COMEX was designed as a hedging market. Miners locked in future prices. Manufacturers secured supply costs. Speculators provided liquidity. The physical delivery mechanism existed, but it was a technicality, a backstop that rarely got tested. In a typical year, actual deliveries represented a tiny fraction of total trading volume. The system worked the way fractional reserve banking works. As long as everyone does not show up at the same time demanding their deposits, the math holds. But the math depends entirely on confidence. That confidence began cracking in 2220. Since that year, registered silver inventory on the COMEX, the metal with delivery warrants attached, the only metal that actually backs futures contracts, has declined by more than 75%. From a peak near 152 million ounces in February 2021, registered stock has collapsed to levels not seen in modern market history. And the decline has not been gradual. It has been a staircase pattern, each major delivery month stripping away another layer of available metal. If this kind of structural breakdown is clicking into place for you, and you are starting to see the machinery behind the numbers, hit like and subscribe. Because what comes next is where the January crash, the Chinese intervention, and the March deadline all converge into a single picture. Meanwhile, on the demand side, something fundamental was shifting. Silver's industrial consumption crossed a critical threshold. Solar panel manufacturing, electric vehicles, artificial intelligence hardware, 5th-generation telecommunications, infrastructure. These sectors now absorb more than half of all annual silver production. The Silver Institute confirmed that 2026 marks the 6th consecutive year of global supply deficit, with demand exceeding mine output by an estimated 160 to 200 million ounces annually. Unlike investment demand, which ebbs and flows with sentiment, industrial demand is price inelastic. A solar panel manufacturer cannot substitute silver out of their production line next quarter because the price doubled. Engineering changes take years. Retooling factories takes capital and certification cycles that stretch across multiple budget periods. So the foundation was laid, a paper market hemorrhaging physical inventory, an industrial sector consuming more than mines could produce, a deficit widening every single year. The system needed one thing to hold together: the quiet assumption that delivery demand would stay low, that futures traders would keep rolling their contracts forward, that nobody would call the bluff. Then January 2026 happened, and the bluff was called. On January 1st, 2026, the Chinese government reclassified silver as a strategic material and activated export restrictions, limiting how much domestic producers could sell to international markets. China is the world's second largest silver exporter. Overnight, a major artery of global supply was constricted. The restrictions remain in force through the end of 2027, and they served a dual purpose: protecting China's own manufacturing supply chains for electronics and solar production, and creating leverage in trade negotiations with the United States and Europe. The market response was immediate and violent. Silver, which had already gained 144% through 2025, went parabolic. Prices surged past $90, then past $100, shattering a psychological barrier that had stood for the entire modern era of precious metals trading. By January 29th, silver touched $121.64 per ounce. In Shanghai, Chinese retail investors flooded into the UBS SDIC Silver Futures Fund, the only public vehicle in China for silver futures exposure, driving it to a staggering 36% premium over its net asset value. Trading volume on the iShares. Silver Trust in New York exceeded $40 billion in a single session, making it one of the most traded securities on the planet. Call option volume on SLV surpassed that of the main NASDAQ 100 ETF. Silver was no longer a commodity side story. It was a global phenomenon. And then the system hit its circuit breakers. The Shanghai Futures Exchange raised margin requirements, reduced daily position limits, and barred 16 clients from opening new positions. The CME Group pushed silver margin requirements to 20%. Bloomberg reported that Trump was planning to nominate Kevin Warsh as the next Federal Reserve Chair, a hawkish signal that reversed dollar weakness in a matter of hours. On January 31st, silver cratered 31% in less than 20 hours, the largest single-day decline since the Hunt brothers' collapse in 1980. Gold dropped 9% alongside it. Treasury Secretary Scott Bessent publicly attributed the crash to Chinese speculative activity, calling it a speculative blow-off driven by leveraged mania. But here is what the crash narrative obscures. And this is the distinction that separates casual observers from structural analysts. The paper market broke. Leveraged positions were annihilated. Margin calls cascaded through every time zone. That part of the system did what circuit breakers are designed to do: force liquidation and reset pricing. The physical market told a completely different story. During the first 2 weeks of January, over 33 million ounces of silver were physically withdrawn from COMEX vaults, 26% of registered inventory gone in a single week. Silver lease rates, the cost of borrowing actual metal, exploded to 8% annualized, up from the normal range below 0.5%. When market participants pay 8% just to borrow silver for a few weeks, that is not speculation. That is desperation for physical supply in a market running dry. The crash flushed the paper. It did not touch the physical shortage. And now, with March first notice day 11 days away, the unresolved tension between those two realities is about to be tested at a scale that dwarfs anything January delivered. Here is where every thread in this story converges into a single frame. COMEX registered silver just fell below 100 million ounces, a threshold the market has watched for months. A single-day withdrawal on February 11th removed over 3.2 million ounces from the registered category. Eligible inventory dropped by 4.7 million ounces in the same 24 hours. Total system drainage, 4.7 million ounces in one day. Shanghai silver continues to trade at a $10 premium above Western spot prices. That premium is not a currency artifact. It is a direct measure of how desperately the Eastern market wants physical metal. The Western paper system cannot deliver at current prices. Now, consider what March looks like through this lens. Open interest on the March contract represents approximately 500 million ounces. Historically, major delivery months see only a small fraction of that standing for physical settlement. But 2026 has obliterated every historical precedent in the book. January, a minor delivery month, processed 49 million ounces of deliveries, more than 7 times the prior year's volume. February saw a delivery rate approaching 98% of contracts reaching settlement windows. If March follows even a fraction of this intensity, if just 20% of open interest demands physical metal, the exchange would need to produce 100 million ounces. That is effectively everything currently registered. If the pattern matches January and February's trajectory, demand could reach 200 to 300 million ounces. Against a shrinking vault that may hold 85 million by the time the window opens, there is a question woven through all of this that no mainstream financial outlet is asking directly. At what point does a futures exchange stop being a price discovery mechanism and start functioning as a rationing system? When delivery demand consistently exceeds available supply, the exchange does not discover the price of silver, it discovers the price of paper. Drop your analysis in the comments because the distance between those two prices is where the real story lives. And some of the most incisive thinking on this channel comes directly from your responses. The COMEX has tools to manage this. Cash settlement, paying the dollar equivalent instead of delivering metal, is always available and has been deployed throughout market history. But cash settlement at scale transmits a very specific signal to the global market. We do not have the metal, and that signal, once broadcast, does not stay contained to one exchange. It reprices physical silver everywhere. It validates the Shanghai premium. It confirms what lease rates have been screaming for weeks. The paper architecture and the physical reality have diverged, and the gap is widening with every vault report. JP Morgan's Metals Research Division stated directly in their February 10th analysis that they remained cautious on re-engaging silver until the recent froth has been fully shaken out. But froth implies excess. What the vault data reveals is the opposite of excess, a market being systematically drained of deliverable supply, while paper positioning adjusts above it. The froth was in the paper. The scarcity is in the vaults. Those are two fundamentally different diagnoses, and only one of them has been treated. So where does this leave us? 11 days from the most consequential delivery month in modern silver market history. Silver sits at $77 today. That is a 36% decline from the January peak and a new low for 2026. The gold to silver ratio has surged to multi-decade extremes, signaling that silver has underperformed its sister metal by a historic margin during the correction. On the surface, it looks like the crisis passed. The speculative mania unwound. Margin calls did their work, prices corrected, the system survived. But pull back from the price chart and examine what did not correct. The supply deficit did not correct. The sixth consecutive year of demand exceeding production is already confirmed, and the Silver Institute projects another annual shortfall approaching 200 million ounces. China's export restrictions did not correct. They remain in force through 2027, and while President Trump's planned April visit to Beijing has trade negotiations on the agenda, no indication exists that silver export policy is a priority item. COMEX inventory did not correct. Registered stock continued declining through February, even as the spot price fell by a third. The industrial consumption trajectory did not correct. Solar installations keep scaling, AI infrastructure keeps expanding, and the engineering timelines to substitute silver out of these supply chains are measured in years, not quarters. What corrected was leverage. What corrected was sentiment. What corrected was the speculative distance between the momentum price and the physical floor. And now silver sits at that floor. The zone between $75 and $82 that multiple analysts have identified as the convergence point, where industrial value meets structural investment demand. Below this level, mining economics deteriorate and supply contracts further. Above it, the deficit continues tightening available metal every single month. The 11-day countdown to March is not a prediction of a single dramatic event. It is a recognition that the system's foundational assumption, that delivery demand will remain manageable, has already been violated twice in 2026. Each violation drains more inventory. Each drain raises the stakes for the following delivery cycle. This is not a one-time shock. It is a repeating stress test on an architecture that was never engineered for this magnitude of physical withdrawal. Remember the number from the opening. 500 million ounces of paper against less than 100 million ounces of physical metal. That ratio persisted for years without consequence because confidence held. Confidence held because nobody tested the delivery mechanism at scale. In January, it was tested. In February, it was tested again. In 11 days, March will test it at a magnitude that dwarfs both. The vaults are not empty, but they are emptying. And in a system built on the premise of perpetual rollover, the distance between not yet empty and structurally insufficient is not measured in years. It is measured in delivery cycles. The paper promises are still being written. The metal is still walking out the door. And the clock, as of today, reads 11 days.